Hello traders, the title of the video is how to avoid the Elliott wave count analysis shock waves like a pro. Alright, you want to avoid the Elliott wave count shock waves. What do I mean by that? Alright, so sometimes you are counting wave, especially you will be expecting a correction. Alright, those are the time when people usually expect the shock waves of the Elliott wave count. What is happening is that one is expecting a correction, but the price continue to go up, all right, and because one has counted 5 waves, all right, it happens all the time. And I have one example here. I find it very interesting. That's what I want to share with you. So you are pre-warned, so you do not get into the same problem. So you can know exactly how to handle that. All right. Now, you can see on the monthly chart, okay, I counted my wave. So this section here, all the way up here, that's the first wave of a higher degree. That is subdivided into 5 minor waves in red. All right. Then we have the second wave of a higher degree, retesting the moving average 100. And then we have the third wave of a higher degree. And then we have the fourth wave of a higher degree. We are now in the fifth wave of a higher degree. Stay with me, because what I'm going to do later is that I'm going to go into the mind of other traders. You can see other line here to show you how other traders may count their wave. So I may compare my wave count to those traders and decide what to do, whether there is a huge significant difference between my wave count and other traders, all right, to see the different scenario that can occur. All right, this is about being prepared and taking the right action when something is happening. So I'll be looking at my own wave count, I'll be looking at the wave count of others, so I'm prepared. But the point, I don't want to stray away from the main topic today. It's about, okay, how to avoid the Elliott wave count analysis shock waves. So today I did analyze another stock today, and it looks like this one. And this is the reason why I want to record this video also, so you may understand what is happening here. Because, all right, other trader, if you look carefully, a trader may say to me, Joe, this is the first wave. I agree with your first wave. I agree with your second wave, George. I agree with your third wave, but I do not agree with your fourth wave, because my fourth wave is right here, and George, this is the fifth wave right there. All right, so that trader may say, all right, from here all the way up there, that's a multi-wave. Now that multi-wave that we are calling 5, all right, we will call it that 1, and this will be 2, and then we are now in another third wave of a higher degree, something like that. All right, now what I want you to do is that think of that trader. Suppose you were here. Think of it that this price action, I'm going to cover it now, did not happen. All right? And you were here. All right? So you'll be saying first wave, second wave, third wave, all right, fourth wave, and the fifth wave, yes or no? And then you will be expecting a correction here. So you will say, the trend has started in 97. It looks to me that it's about to come down. Now this is about how to avoid Elliott wave count shock wave, especially when you count 5 waves. Anytime you count 5 waves, all right, the price can still break above that 5th wave. First, the 5th wave itself can be extended. That will be one reason. Another reason will be, all right, a wave of a higher degree may start. All right? Or there were other wave extensions that you have not taken into consideration. Because when you were here, it looks like a double top, yes or no? So the price, you see, in fact, if you apply, let me do that now, because I want you to see. So whenever you count 5 waves, all right, you are not just expecting a correction by all means. So if you apply, I'm going to apply Fibonacci extension to the first wave. Alright, so we can check whether there is an Elliott. So this first wave subdivided into 5, I'm applying Fibonacci extension to it. You can see that the third wave went above the 161.8% Fibonacci extension level, so just a little bit. So this is a normal third wave, because if that third wave couldn't go above the 138.2% Fibonacci extension level of the first wave, we will put a big question mark on that third wave. So the good news is that it went above the 138.2%, even the 161.8% level. So it's a healthy, normal, third wave, not expanded third wave. This is a normal third wave. All right. So that verification is done. So our wave count, everything's look good. First wave, second wave, third wave, fourth wave, fifth wave. This is about another trader, counting his way this way. So for that trader at that point in time, he needs to be very careful, because his wave count, there is no Elliott wave violation. Everything looks good, all right? And you see 1, 2, 3, 4, 5. He is expecting a pullback, all right? That's normal. So in order to avoid the Elliott wave count shock waves, all right, so big surprises, which you do not want, is that you draw a line at what you are calling fill, and you are giving priority to bullish signal above it, and you are giving priority to bearish signal below it. So you don't want to fight it if the price goes above what you are calling fifth wave, because you can think of an extension or a higher degree wave count expanding. This is very, very important. Now, this is this chart here. So I'm going to go back. Stay with me, please, because I want to show you the other chart I'm talking about that you need to watch, and then you understand more what I'm trying to highlight here. Okay, and then we're going to come back again to our wake up. So the financial instrument that I'm talking about is APDZ. Yes, this one. Was it this one? Yes, this one. Okay. So again, look at that. 1, 2, 3, 4, 5. Okay. Yes. And then he pulled back here. All right. So this is 5, isn't it? This is 5 here. Now, and then we were expecting a correction. Now the correction has begun. Down. So 1, 2, 3, 4, 5 becomes 1, and we call this one 2. And then I was telling you in that video, a video that I recorded today, talking about how to count Elliott wave by admiring the price action. Check it out. All right. So now that we are here, all right, it is quite rare. It does not happen frequently that after a multi-wave and a move down at this, that we may have a new impulse wave. I don't want to say a trend, I want to say impulse wave. Sometimes you may not see that, especially if the multi-wave is prolonged. So you can see this one 684, all right, and up to 2008, and then we have this correction. So in normal condition, after all these many years, we will expect a correction, a complex correction, like at least a zigzag, which means one move, sharp move down, one move up here. That's what people were selling here around, to bring another price move down, because the multi-wave has been too long, and we will expect a correction that settle all the differences between at least a zigzag or a complex correction or a WXY wave. What I'm trying to say to you here, to avoid the Elliott wave count short wave, which means at this point in time for this talk, personally, as I'm looking at it now, I do not believe that this should be a new trend. In my mind, this is about myself, in my mind, I would prefer the correction to take a little bit longer than this one, instead of just hit the ground, hit the moving average 200, and start a new impulse wave. So with that mindset, I can be burnt, okay, burnt, okay, B-E-N, bent, B-E-N-T, bent to sell, because I'm expecting a move down. So you see this one, sharp move down, 1, 2, 3 here. I'll be, when I sell here, I'll be expecting the price to continue to go down more, at least to give us a double bottom, or to dwell here a little bit longer before a new impulse wave. But sometimes, some stock, all right, they will, like you see here, the trend has been long, and then it come down here, the moving average 200, and as I was telling you here, I'm not expecting another impulse wave. But as I was showing you on that chart, the first chart that I was showing you, the price after just pulling back, it start a new impulse wave. So sometimes you will face that challenge because your mindset, or because of your expectation, because of what the price usually do, because after a long, prolonged multi-wave, we usually see a complex wave. Minimum, we will expect a zigzag, all right? But sometimes some stock will come down with one move down, and we just run away. That's why, in order to avoid the area wave con short wave, we don't want to be too rigid. We want to be flexible, though we are human beings. Sometimes we have something in our mind, and we stick to that. We want to understand that we want to avoid the area wave con shock wave, and if we start running away, doing things that we were not expecting, or doing things that we do not want, in fact, we do not want it, in fact, all right, we need to be prepared to handle, okay, what the price is doing, which means, as I was discussing this financial instrument in that video, I was telling you that I do not really believe that this should be a new trend, but it can end up being a new trend, a new impulse wave, which means this should be exactly the second wave, and the price will form another third wave before. That's why you see here, when I was doing the video, I put, is it the third, question mark, because I was, in my mind, I don't want it. I don't want it to be the third wave. That's what's happening. But not wanting it doesn't mean that it cannot happen. Right? So we put a question mark on it. It's now in this green triangle. It may just break a ball and continue to go out, exhibiting a new, okay, third wave. So you see that very often after you count, you see a clear-cut multi-wave that has been prolonged, and you are expecting, okay, a more complex, a more prolonged corrective. The price, sometimes some of the stock that are very bullish, they will just pull back to the sweet spot zone, which is the zone between the 50% and 61.8% Fibonacci retracement level of the multi-wave, and then we'll start another impulse wave extending the higher degree, okay, cycle. All right, so you see this one now. So the one I was showing you at the start of this tutorial, okay, is in a third wave, but this one here, this is what I'm trying to highlight to you, right? So you may understand, okay, the challenge that we face, because our mindsets will affect our trading definitely. And here it is forming, all right, a fifth wave of a higher degree. Now, so I'll show you one scenario going to the mind of other traders that are calling this session here the fifth wave already. I will not go back to that. I will try again to go into the mind of other traders. Another trader may say, George, this is the first wave. I agree with you. This is the second wave. I agree with you. But George, I disagree with you for the third wave. In fact, that third wave is still going on. So why you are calling George the third wave of a higher degree is the first minor wave of that third wave of a higher degree in green. And why you are calling the fourth wave George, that is the second minor wave of the third wave of a higher degree. And why you are calling the fifth wave George, that's the third wave of a higher degree. A third minor wave, okay, of the third wave of a higher degree. We will be having, okay, the fourth minor wave of the third wave of a higher degree, and a fifth minor wave of the third wave of a higher degree, and the real third wave of a higher degree will end here instead of here. And then we'll have the fourth wave of a higher degree followed by the fifth wave. So so far I'm going to the mind of two types of traders. One saying that the fifth wave ends here, right? Another one saying to me, George, in fact, the third wave will end here. So the question is there a big difference between myself and those traders? So the trader that is saying this is the fifth wave will be expecting a correction at that point in time, expecting the price to go down. All right, so he will be expecting a deeper move down, and I will be expecting a shallow move down, forming the fourth wave. In this case, I won because the price continued to go up. All right. For a trader that is saying that, George, the third wave is not yet finished, he's here, he's calling this one the third manual wave or the third wave. So what is he expecting now? He's expecting a pullback to form, okay, the fourth manual wave. I'm also expecting a pullback in the form of correction. So I'm expecting a deeper correction, and he's expecting a shallow correction. The difference is not too big. He wants his correction to be deep. I want my correction to be shallow. If it's a shallow here, as the price comes somewhere near here, this point here, I will be controlling my risk. If you went beyond, then I'll know that, okay, the other group of traders, okay, I am the one expecting a deeper correction, okay, and because my fifth is here, I'm expecting a deeper correction. He's expecting a shallow correction. So if the price comes here, I'll be watching and say, well, all right, let's see whether the other group of traders, okay, are right or wrong. If you go beyond their point, continue to go down more, I'll know that, okay, my wave count is wrong. Or I may say maybe it's a flat correction that's going to be formed, or an expanded flat correction can form. So which means a double retracement here, going down, up, forming the B part of the flat correction before coming down. So I think that in this point in time, comparing the second wave count to my wave count, the difference is not too big, and I can still, okay, be part of the trade as long as, okay, I'm concentrating on the price. So to avoid all disagreement and to avoid, okay, shock wave, one must concentrate on what? The price. So you see. So we do not trade the technical indicators, all right? We are using the area wave to interpret the structure of the price, but we don't want to use the area wave ahead of the price. We want the price to confirm the area wave count. So as I show you already, you see, this is a tricky one when you see 5. The shock wave is that you are expecting a deeper correction. Your mind is set, you say, okay, market is going to crash, market is going to come down, a correction is due. Okay, and then you continue to go out. That's the shock wave. You need to know how to handle that and control it, and know that there is an extension or a bigger area wave circle is expanding, so you may connect the dot. At the same time, you want to go into the mind of other traders, because there are traders come with different way, all right? So they may disagree with you, they stick to their way count, so that's how they're going to trade. They're going to buy because of their way count. They're going to sell because of their way count. So you can't tell them what to do. But then we want to know what they are doing, so we can read the market carefully when something else is happening, when something different from our expectation. Well, I think I've said enough about this video, about how, okay, to avoid area wave analysis, shock waves like a pro. The reason why I'm recording the video is that a lot of area wave traders, all they need to do is to work on that problem that they are facing. They are facing a lot of shock wave after shock wave. And at one point, they will come to abandon the area wave theory and say, oh, I use it, this thing doesn't work. It's not true. Or they are losing because whoever taught them about the area wave told them that that's it. It's like a science. It worked beautifully. And they only show them example when the forecast is accurate. All right? They never show them time when their forecast has been, okay, nullified or has changed. So people go around believing that, okay, it must be always what one is expecting, but sometimes the price will do something else, and one can adjust accordingly and flow with the price using the market pattern, draw a trend line, market geometry, and trade the price itself. Okay, so this is it. All right. So if you find this video truly useful, please let us know by giving us the thumbs up. If you dislike it, please mark it down. If you think that this is another, okay, if you think it's an essential tutorial, okay, feel free to share with your friend on Google+, on Twitter, on Facebook, and also on Tumblr. If you have not yet subscribed to our channel, please subscribe to our channel. It is free. And click on the notification bell so anytime we record a new video, you will be the first person to be notified. Until the next time, enjoy yourself and be very happy. We are the TSTW 24 traders talking about how to avoid Elliott wave count analysis, shock waves like a pro. All right, for those of you who are still who are trading this financial instrument, you can see that the stochastic 833 stay overbought for a long time, indicating to us that the move that we see here is either a third wave or it's an impulse wave or a multi-wave. It is a multi-wave subdivided into 5 waves: 1, 2, 3, 4, 5. We will see what will happen next. All right. Happy trading to you all, and I will speak to you soon. Thank you for watching. The financial instrument that we are analyzing today is ANSS Incorporated. I hope my pronunciation is correct. EPIC Alpha November Sierra Sierra, ANSS, belonging to the technology sector, software application, and American stock on the monthly chart. Thank you for watching.